All right, let's talk about a serious fight brewing in the world of high-performance sportswear. On one side, you've got the Swiss upstart, On, this disruptive force that seems to be everywhere right now. And on the other, the Japanese titan, ASICS, a legendary brand with decades of engineering mastery. Trust me, this is way more than just a battle over sneakers. It's a full-on war for market share, for your loyalty, and for who owns the future of performance tech.
But here's why we're really digging in today. Beyond the finish lines and marketing campaigns, this is a race that could have a big impact on your portfolio. We're going to cut through the hype, get straight to the balance sheets, and answer one critical question. As we look ahead to 2026, which of these two powerhouses makes the better investment?
So here's our game plan for this breakdown. First, we'll dive into On's absolutely aggressive scale-up strategy. Then we'll see how ASICS pivoted to become a master of profitability. After that, we'll pit them head-to-head in a financial duel, before we give you our final investment verdict for 2026. Okay, first up, On Holding. The best way to think about them is as the high-growth teenager of the industry. You know the type, moving incredibly fast, shaking things up, and plowing every single dollar they have back into massive expansion. And when I say growth, I am not kidding. On posted a blistering 30% revenue growth in its 2025 fiscal year. That's not just a nice number. That's the kind of figure that signals a brand with some serious momentum. So where is all this explosive growth really coming from? Well, this chart tells a very clear story. The Americas are On's absolute fortress, making up almost 58% of their sales. They didn't just enter the world's biggest consumer market, they've successfully made it their primary engine for global growth. So how are they fueling this fire? It's really a four-pronged attack. They're boosting their high-margin direct-to-consumer business, which is now almost 42% of their sales. They are expanding like crazy in Asia-Pacific, with a staggering 96% growth. And at the same time, they're pushing new tech and breaking into new sports, like tennis, with a little help from icons like Roger Federer. Now, let's totally switch gears and talk about ASICS. You see, if On is that growth-obsessed teenager, ASICS is the savvy veteran. They're not just chasing growth for growth's sake. No, they are playing a completely different game, one focused on extreme efficiency and, you guessed it, profitability. And this number right here perfectly sums up their strategy, a return on equity of 39.1%. Now, for anyone not familiar, ROE basically measures how much profit a company squeezes out of the money shareholders have invested. An ROE of nearly 40% is frankly incredible. It tells us ASICS isn't just making money, it's an absolute master at using its capital efficiently. So how do they pull this off? It all comes down to their powerful, diversified brand matrix. Performance running, that's their bread and butter, their rock-solid core. But the real magic is in the other pillars. Sports style is tapping into that massive lifestyle trend, while the Onitsuka Tiger brand, well, it operates almost like a luxury fashion house, delivering just fantastic margins. This isn't just a running company, it's a finely tuned portfolio. And all of that profit lets them do one thing exceptionally well: reward their shareholders. I mean, in 2025 alone, ASICS paid out over $105 million in dividends and bought back over $334 million of its own stock. This is the classic playbook of a mature company that's laser-focused on shareholder returns. All right, we've seen the two very different playbooks. Now it's time for the main event. Let's put them head-to-head in the financial duel and see what the numbers really tell us. This table really lays it all bare, and it tells such a fascinating story. At first glance, ASICS is the bigger beast, right? It wins on revenue and pure profit. But hold on, look closer. On takes the crown for growth rate and, this is critical, for gross margin. That 62.8% margin is proof that its premium pricing strategy is absolutely working. Meanwhile, ASICS just dominates on pure efficiency with that mind-blowing ROE. This isn't a simple knockout. It's a classic tale of the disruptor versus the profitable incumbent. So let's just boil this all down. On's strategy is all about high margin, high spend. They get a premium price for their product, and then they reinvest that cash heavily to fuel more growth. ASICS, on the other hand, is a machine of high efficiency, high return. They use their massive scale to generate huge profits and then give it back to shareholders. Two completely different paths to success. But before we declare a winner on profitability, there is a critical detail hiding in On's financial statements. It's something called an unrealized FX loss. Now, stay with me. I know this sounds technical, but it has a huge impact. All it means is a loss that exists only on paper because of changing currency values. It's not a real cash loss from the business itself. And the impact is massive. In 2025, this paper loss wiped out nearly $140 million from On's reported profit. The key takeaway here is that On's underlying business is actually much more profitable than it looks on the surface. This wasn't a business failure. It was an accounting hit from the foreign exchange markets. That's a really important distinction. Okay, so with all that data on the table, the growth, the profitability, those tricky accounting nuances, it's time to bring it all together and deliver the investment verdict for 2026. You know, this quote from the source research just perfectly captures this entire story. On is in a high-burn investment phase. They're spending big to build an empire. ASICS, having already built its empire, is now in a value recovery phase, simply harvesting the massive profits. So what does this actually mean for you? Well, it really just boils down to what kind of investor you are. If you're a growth investor, you're betting that On's premium brand and disruptive energy will eventually lead to massive profits down the line. The big risk? That super high spending and their heavy reliance on manufacturing in Vietnam. But if you're more of a value investor, ASICS offers proven stability and shareholder returns. The key risk for them? Well, can they possibly maintain that incredibly high ROE year after year? And this image right here brilliantly illustrates On's path forward. Their big bet isn't just on running. It's on becoming a full-fledged sportswear giant. By signing the world's #1 tennis player, Iga Swiatek, they're basically buying instant credibility and making an aggressive move into a very lucrative new market. This is what that high-burn investment is actually paying for. And so that leaves us with the ultimate billion-dollar question. Can On's aggressive, high-margin expansion eventually mature into the kind of profit-making machine that ASICS is today? Or will the savvy veteran's disciplined, hyper-efficient model prove to be the stronger, more durable strategy in the long run? That is the question investors now have to decide. This whole explainer was based on a deep dive report from HDIN Research. So if you want to explore all the data for yourself and get into the real nitty-gritty, you can find the full analysis over at hdinresearch.com.